My husband's attorney slid a financial disclosure across the table and said, Mr. Delaney has been fully transparent about his assets. As you can see, his net worth at the time of filing is approximately $74,000. I looked at the document. I looked at my attorney, and then I looked at my husband across the table, the man I had been married to for 16 years, and I watched him hold my gaze with the practiced steadiness of someone who has been rehearsing that expression for months. I looked back down at the document, $74,000. That was what Kevin Delaney claimed to own after 16 years of dual incomes, a paid-off car, a house with significant equity, 2 retirement accounts, and a business he had been running for 11 years. I had been a forensic accountant for 17 years. I had built an entire career on finding money that people claimed did not exist. And my husband, who had watched me do that work, who had heard me describe that work at dinner tables and holiday parties, and in bed on Sunday mornings when he asked about my week, had handed me a financial disclosure showing $74,000. I actually smiled, not at him, just at the document, the quiet, involuntary smile of someone who has been handed exactly what they were expecting, my attorney noticed. She put her hand briefly on my forearm. I said quietly, "We're going to need more time," she said. "How much time?" I said, "Give me 60 days and a subpoena for his business accounts." She said, "What are we looking for?" I said, $300,000, give or take. The room went very still. That was the beginning of the end of the second phase of my life, and the beginning of the third. I want to tell you how I knew. Because the knowing did not happen in that conference room. It happened slowly, over 9 months, in my home office in Atlanta, Georgia, at a desk covered in printed bank statements and a spreadsheet that grew longer every week. My name is Simone Delaney. I am 44 years old, and I have spent 17 years working in financial fraud examination, corporate audits, insurance claims, divorce asset investigations, and estate disputes. I live in Atlanta, and I have built my practice carefully over those years. Taking keys that require patience and precision, and the willingness to read 1,000 pages of financial records to find the 3 lines that matter. I am telling you this because it matters for what comes next. I am not a woman who mistrusting signs since I am not someone who trusted blindly. I am someone who understood on an intellectual level exactly how hidden assets work, exactly what the mechanisms are, exactly what to look for. And it still took me 9 months to find it all. Because Kevin was not stupid. He was careful, and he was patient, and he had 17 years of watching me work to understand what I would look for and how to make it harder to find. That is the part of this story that is hardest to tell. Not that my husband hid money. That he used everything he knew about me to do it better. Kevin and I met in our late 20s at a work event, one of those industry conferences where everyone is slightly too well dressed, and the drinks are free, and conversations happen quickly because everyone is aware the evening is finite. He was in sales, medical device sales, which is a specific kind of person, charming, persistent, comfortable with numbers, used to hearing no and treating it as a starting point rather than an ending. He was good at it. He was good at most things that required reading a room and adjusting accordingly. He was also genuinely curious about my work in a way that I found attractive at the time. Most people hear forensic accountant and their eyes glaze politely. Kevin asked follow-up questions. He wanted to understand the mechanics, how hidden money moved, how people thought they could conceal it where they always made mistakes. I thought it was intellectual interest. It was. It was also something else, which I understand now. We were married in our early 30s, at a small ceremony in the North Georgia mountains with about 40 people and a dinner that went on pleasantly until midnight. We bought a house in a suburb of Atlanta 3 years later, 4-bedroom craftsman, that we spent 2 years renovating slowly, room by room, the way couples do when they have more time than money, and then more money than time. We stripped floors, we replastered walls. We argued over tile and agreed on paint colors and built something that felt genuinely like ours. We did not have children. That was a decision we made together, revisited regularly, and eventually closed the door on without crisis or regret. We built our life around 2 careers, and a house and friends and travel, and the specific rhythms that people develop when they have spent enough years together, that the rhythms become invisible. We had, for most of our marriage, a genuinely good life. I want to be honest about that because it matters. Kevin was a good companion, curious, funny, generous with his attention when he was present. He remembered things I said in passing weeks later. He cooked on Sundays. He knew how I took my coffee without asking. The problems were not dramatic. They were the slow, quiet problems of two people who grew in different directions and stopped noticing when the gap widened until the gap was larger than anything in the foreground. I noticed it first, I think, around year 10. A kind of low-level hum of absence. Not physical absence, but the deeper kind. We were in the same rooms and talking about the same things, and I was managing the house and the taxes and the insurance and the joint accounts, and Kevin was building his business, and we were, from the outside, fine. We were perfectly fine. By year 12, I was aware that the marriage was something I was maintaining rather than something I was living inside. By year 14, I think Kevin knew it too. We never had a dramatic fight. We never had an affair, as far as I know. We just arrived, somewhere in year 15, at a mutual and unspoken understanding that we were waiting for something, the right moment, the right conversation, the right version of courage. He found his version first. He filed in January of year 16. I was not surprised. What I was not expecting was the financial disclosure. We had combined finances for most of our marriage. Joint checking, joint savings, a joint investment account. We also each maintained individual retirement accounts. And Kevin had a business account for the LLC he had started 11 years earlier, a medical device consulting firm he ran with one part-time contractor. The business was modest in its early years. It had grown. When Kevin filed, he was required under Georgia law to file a financial disclosure, a sworn statement of all assets, all debts, all income, all property. His disclosure listed the following: the house, valued at $380,000, with a mortgage balance of $141,000, leaving equity of $209,000. A joint investment account, $48,000. His individual retirement in dollars. His business, Delaney Consulting LLC, valued at $31,000. Described as having minimal liquid assets and primarily consisting of client relationships equipment, one vehicle, $14,000. Personal checking account, $6,200. Personal savings, $2,800. Total disclosed assets, excluding the house, approximately $169,000. With the house equity, total net worth approximately $408,000, which, split, would yield roughly $204,000 each. I read the disclosure on a Tuesday night at my kitchen table, and I went through it the way I go through every financial document. Line by line, looking for what was missing rather than what was there. The retirement account number was too low. Kevin had been contributing to his IRA for 15 years. I knew this because we had discussed it regularly. It was one of the things he was genuinely consistent about, maxing his annual contribution every year. At his contribution rate and a reasonable average market return, his IRA should have been significantly higher than $67,000. I went to the folder where I kept our tax returns. I had always managed our taxes, which meant I had every return going back 14 years, and I pulled the most recent 5. On each return, Kevin had reported IRA contributions. The amounts were consistent. At maximum contribution rates over 15 years, with market growth, his IRA should have been closer to $180,000. The disclosure showed $67,000. The difference, $113,000, that was the first number that did not match. And I have learned, in 17 years of this work, that the first number that does not match is never the only one. I retained a divorce attorney named Claudia Marsh the week after Kevin filed. Claudia was 61 years old, had been practicing family law in Atlanta for 30 years, and had a manner that was simultaneously warm and completely unsentimental. She had worked with forensic accountants in divorce cases before and understood immediately what I was telling her when I laid out the IRA discrepancy. She said, "How confident are you?" I said, "The contribution records are on 14 years of tax returns that I prepared. I'm extremely confident." She said, "What else are you looking for?" I said, "The business. He's valued the LLC at $31,000. I think that number is grazing by a significant amount." She said, "How significant?" I said, "I don't know yet, that's what I'm going to find out." She filed a formal discovery request within the week. Subpoenas for Kevin's personal financial accounts, his business accounts, and 5 years of business tax returns. Kevin's attorney objected on the grounds that the business valuation would be handled by a neutral third-party appraiser. Claudia said, "Fine, we'll have our own appraiser, and we'll still need the account records." Kevin's attorney pushed back for 6 weeks. 6 weeks of procedural delay while Kevin had access to his accounts and I had only what I had already gathered. I used these 6 weeks. I want to explain what I did during those 6 weeks, because I think people imagine forensic accounting as something that requires access to protected systems or insider information. It does not. What it requires is patience, attention to detail, and the willingness to cross-reference publicly available information against private records you already have legal access to. I had been doing exactly this for 17 years. First me. The only thing different about this particular investigation was that it was personal, and I had to work harder than usual to keep my professional discipline from being corroded by the personal. I started with the business. Delaney Consulting LLC was registered in Georgia. Business filings are public records. I pulled the annual registration documents from the Georgia Secretary of State's database, available online, free to any member of the public. Free. The registrations listed the registered agent, the principal office address, and in some years, additional officers or amendments. In the most recent registration, there was a change I had not known about. 3 years earlier, Kevin had added a registered agent address in Delaware. Not incorporated in Delaware, the LLC remained a Georgia entity, but with a registered agent in Delaware handling some correspondence. That was unusual for a small consulting firm with one part-time contractor and clients in the Southeast. Delaware registered agents are typically used when a company has multi-state operations, is seeking investment, or has specific privacy reasons for separating its correspondence from its operating address. For a two-person medical device consulting business in Atlanta with regional clients, there was no obvious operational reason for a Delaware registered agent. I noted it. I did not draw conclusions from it yet. I noted it the way I note everything at the beginning of an investigation as a question mark, not an answer. I looked next at Kevin's professional presence. He maintained a LinkedIn profile and a simple business website. I had seen both before, obviously, but I looked at them now the way I look at documents, for what the numbers implied rather than what the words said. His LinkedIn listed his clients by industry: hospital systems, regional medical device distributors, outpatient surgical centers. His website listed case studies, anonymized but detailed in a way that communicated scale and sophistication. The case studies described work that a $31,000 business could not have produced. One described a 2-year consulting engagement with a regional hospital network on supply chain restructuring. One described a national distributor engagement involving multi-state compliance. These were not small, informal projects. 4. They were sustained, complex engagements, requiring the kind of infrastructure and staff time that a business with one part-time contractor could only accomplish if the revenue supported it. I started searching public records for medical device consulting contracts in the Southeast over the previous 5 years. Georgia has open records laws for state contracts, and several of the hospital networks Kevin had listed as client industries were state-affiliated. I filed open records requests with 3 of them. 2 came back with nothing relevant. 1 came back with a contract. A 2-year consulting agreement between a Georgia state-affiliated hospital network and Delaney Consulting LLC, executed 3 years earlier, for a total contract value of $340,000. I sat at my desk at 11 o'clock on a Thursday night and read that document 3 times, a $340,000 contract. For a business Kevin had disclosed as worth $31,000 with minimal liquid assets. I did not call Claudia that night. I printed the contract, put it in a folder, wrote the date and source on the tab, and went to bed. I did not sleep well. But that had not been new for some time. If you have ever been married to someone for 16 years and discovered, in the middle of a divorce, that you did not know their financial life as well as you thought, you understand that the feeling is not simple. It is not just anger. It is the specific disorientation of realizing that a person you shared a bed with had a private financial reality that they maintained separately from everything you understood about your shared life. Kevin had not hidden his money impulsively in a panic after he decided to file. He had been building the structure for years: the Delaware registered agent, the contract that was not mentioned at home, the IRA that was $113, frozen smaller than it should have been. I thought about the dinners where he had asked about my cases, the specific interest he took in the ones involving business owners, the questions he asked about how people moved money through LLCs. how valuations worked, what the most common hiding methods were, and how they got discovered. He had been taking notes, looking back, and I have looked back more than I probably should. 4. There were other things I noticed in retrospect that I had attributed at the time to different explanations. He had started working later hours about 3 years before the divorce. I had assumed he was growing the business, which he was. He had begun handling more of the household mail himself, which I had read as helpfulness. He had started using a different laptop for work. A personal one, he said, was faster, and leaving it in his car overnight. None of these things, individually, are evidence of anything. Together, with the rest of the picture, they form the outline of someone who was quietly building a parallel financial life while maintaining the appearance of a shared one. Fruit. I was so accustomed to being the one who managed the financial details that I had stopped looking at our shared life with the same eyes I brought to my work. That is the trap of expertise within intimacy. You extend trust exactly where your skills would serve you most, because trust is what intimacy requires, and expertise is what it costs you. Kevin understood this. Whether he counted on it consciously or simply benefited from it, I cannot say. What I know is that the place he chose to hide was the place I had stopped looking. That was the part of this I had to sit with longest. Not the money. The looking away. I am not looking away anymore. I was not devastated by this. I want to be clear about that. I was engaged. I was professionally engaged with the problem in a way that coexisted with the personal pain without canceling it. Both things were true at once. This hurt, and I was very good at this, and the second fact was going to determine the outcome. The subpoena for Kevin's business accounts was finally honored 11 weeks after Claudia filed for it. 4. We received 5 years of bank statements for Delaney Consulting LLC's primary business account, along with 5 years of business tax returns. I sat with those documents for 4 days. I did not sleep much. The business account told the following story. Revenue had grown consistently over 5 years. In the most recent full year, the business had deposited $287,000 in client payments. The prior year, $241,000. The year before that, $196,000. Kevin had disclosed the business as worth $31,000. A business generating $287,000 in annual revenue in a professional consulting field is not worth $31,000. Frowned. A standard revenue multiple for a service business in his industry would place the value somewhere between $400,000 and $600,000, depending on the stability of the client relationships and the transferability of the contracts. Gorn. He had not disclosed a business worth $31,000. He had disclosed a business worth $31,000 that was generating almost $300,000 a year, but the deposits were only part of the picture. I went through the expense side of the business account looking for distributions, the money Kevin had paid himself from the business. In a single-member LLC, owner distributions are not a salary role. They are transfers from the business account to the owner's personal account. They show up as transfers, not payroll. The transfers from the business account to Kevin's personal checking account over the most recent 3 years totaled $164. His personal checking account, in the disclosure, showed a balance of $6,200. $164,000 had flowed from the business to his personal checking account. The personal checking account showed $6,200. Where had the $164,000 gone? I went back to the personal account statements, which the subpoena had also covered. I tracked every outflow from his personal checking over 3 years: monthly expenses, mortgage contribution, utilities, groceries, the ordinary costs of a shared household. I knew what those were. I had been paying them alongside him. After accounting for his share of shared household expenses, Kevin had spent approximately $60,000 from his personal checking over 3 years on personal costs I could identify. That left $104,000 unaccounted for. I looked for transfers. There were recurring transfers, beginning 28 months earlier, to an account I did not recognize. $1,200 every 2 weeks like clockwork, 28 months. 24 pay periods per year. 2.3 years, approximately $66. Brusian in transfers to an unknown account over 28 months. I flagged it and kept looking. There were also 11 cash withdrawals over the 3 years, ranging from $2,000 to $8,000. Total, $41. Brusa in cash withdrawals, with no corresponding expense I could identify. Running total of unaccounted funds, approximately $107,000 from the personal account alone. Before we had even addressed the IRA discrepancy, I added the IRA gap, $113, frozen missing from what the contribution records predicted. I added the cash, $41,000. I added the recurring transfers to the unknown account, $66,000. And I had not yet addressed where the business revenue had actually gone after it left the business account, beyond the distributions I could trace. I opened a new tab in my spreadsheet and labeled it Total Yun Account Free. I typed in the running figure. It was $287,000 and growing. I called Claudia the next morning. Claudia's response, when I walked her through the spreadsheet, was a long silence followed by, "I'm going to need you to testify to this," I said. "I know," she said. "Kevin's attorney is going to argue that you're biased, that you're a forensic accountant who has constructed a theory to maximize your settlement." I said, "The documents are the testimony. I'm just the person who organized them." She said, "What's the unknown account the transfers are going to?" I said, "I don't know yet. That's the next subpoena." She filed it the following week. Court. A subpoena to Kevin's bank for the account receiving the recurring $2,200 transfers. Kevin's attorney objected, claiming the account was a private savings account unrelated to the marital estate. Claudia said, "If it was funded with marital assets over 28 months, it is absolutely related to the marital estate. And if your client disagrees, he can explain under oath why he omitted it from his financial disclosure." The objection was withdrawn. The account records arrived 3 weeks later. The account was a high-yield savings account in Kevin's name only. Opened, I checked the date, 4 months after we had our first conversation about separating. He had opened it 4 months after the first time I told him I was unhappy, and he had been funding it 2 weeks at a time for 28 months. The balance in the account at the time of discovery, $71,400. He'd been building a separate financial reserve for over 2 years. A quiet incremental transfer, small enough to avoid drawing attention, consistent enough to accumulate. By the time he filed for divorce, he had $71,400 sitting in an account that did not appear on his disclosure. I added it to the spreadsheet. The cash withdrawals were harder to trace, because cash does not leave a trail. $41,000 in ATM withdrawals and bank cash transactions over 3 years, in amounts between $2,000 and $8,000. Each one individually plausible as a cash expense, collectively forming a pattern that cash expenses alone could not explain. I could not prove where the cash went. That is the nature of cash. That is why people use it. What I could do was demonstrate, through the totality of the evidence, that Kevin's actual liquid assets significantly exceeded his disclosed amount. The cash was part of a pattern, not an isolated anomaly, and patterns are what matter in a fraud examination. I also returned to the IRA. Claudia subpoenaed Kevin's IRA custodian for 5 years of account records. The records showed something I had not anticipated. The IRA had not simply grown less than expected. It had been partially liquidated. 3 years earlier, Kevin had taken a distribution from the IRA, a withdrawal, not a loan. The distribution was $47,000. He had paid the 10% early withdrawal penalty and the income tax on the distribution, which had been reported on that year's joint tax return, under a line I had prepared without fully examining the source. I pulled that year's return. There it was, a line for IRA distribution income from. I had processed it as routine retirement account activity without looking at the underlying form. Kevin had withdrawn $47,000 from his retirement account 3 years ago. He had paid the penalties and taxes, which reduced the net amount to approximately $36,000 after costs. And the proceeds had gone, I traced them through the business account, into a separate investment account, an investment account not disclosed in his financial statement. Claudia subpoenaed the investment account. It held $83,000 at the time of discovery, having grown from the initial $36,000 deposit over 3 years. I added it to the spreadsheet. Running total of assets not disclosed or deliberately obscured: the hidden savings account, $71,400, the undisclosed investment account, $83,000, the IRA gap from the distribution and subsequent underreporting, $47,000, the cash withdrawals, $41,000, not traceable to destination but documentable as a pattern, the business undervaluation, which are placed at a fair market value of $410,000 versus Kevin's disclosed $31,000. a difference of $370,000 in asset value, not all of which was liquid but all of which was marital. The liquid hidden assets alone, the savings account, the investment account, the IRA distribution proceeds, totaled $242,000. When I added the cash and accounted for the business undervaluation, the total picture of what Kevin had obscured exceeded $300,000. I had told Claudia 60 days. It had taken me 5 months. But the number I had named in that conference room, 300,000, give or take, had turned out to be accurate within a margin I was professionally comfortable with. The spreadsheet had found every dollar. The settlement conference was held on a Thursday morning in October, 14 months after Kevin had filed. It was in a conference room at a mediator's office in Buckhead. A man named Harold Fenn, who had been mediating high-conflict divorces in Atlanta for 20 years, and who had the steady, unflappable demeanor of someone who had seen every version of this situation. Kevin arrived with his attorney, a man named Stuart Vance, who was polished and aggressive in the way of attorneys who represent people with something to protect. Kevin was dressed carefully. He looked the way he always looked in professional situations, composed, confident, slightly above the fray. I had a binder, tabbed, indexed with a table of contents. One copy for Harold, one for Stuart Vance, one for Kevin. Claudia placed them on the table. Kevin looked at the binder. Something shifted in his expression. Not panic, but a recalculation. The look of someone who had anticipated a negotiation and understood, from the weight of the binder alone, that something different was about to happen. Harold opened his copy. He turned to the table of contents. He read it without expression. It listed 12 sections: hidden savings account, undisclosed investment account, IRA distribution and proceeds, cash withdrawal pattern, business account revenue analysis, business valuation discrepancy, summary of unaccounted assets, timeline of account openings relative to separation discussions, annotated tax returns, subpoenaed bank records, appraiser report, legal precedent summary prepared by Claudia. Stuart Vance said, "We haven't reviewed this material," Claudia said. "It's all drawn from documents produced in discovery. Nothing in that binder is new to your client." Kevin was looking at the binder, not opening it, just looking at it. Harold said, "Mr. Delaney, frame. I'm going to ask you and your attorney to take 30 minutes to review the summary section before we begin." Pages 1 through 14, Stuart said, "We'd like to request a continuance to." Harold said, "I'm not granting a continuance today. You have 30 minutes. They went to a side room. I sat with Claudia and drank water and looked out the window at Buckhead in October, the trees beginning to turn, and I thought about nothing in particular. Not Kevin, not the marriage, not the years. I thought about the spreadsheet, the way it had grown over 5 months, one column added at a time, one source verified, one number confirmed, the discipline of it, the honesty of it. Numbers do not get tired. They do not get emotional. They do not revise themselves to protect someone's feelings. They had just done what they always do. They had told the truth. Stuart Vance and Kevin came back from the side room in 22 minutes. Not 30, poor Mim. I had watched the clock. 22 minutes to review 14 pages of documented evidence that had taken me 5 months to build. I thought about what those 22 minutes must have felt like for Kevin. Sitting in a side conference room with his attorney, going through a document that named every account he had hidden, every transfer he had made, every gap between what the records showed and what he had sworn was true. I thought about what he had expected walking into that room. He had expected a negotiation. He had expected Claudia to have suspicions and demands and a number she was willing to fight for. He had not expected a binder with a table of contents. Board. He had not expected the subpoenaed records, organized and annotated, laid out in a sequence that told the story of 3 years of preparation, without a word of my own interpretation inserted anywhere. Just the documents, just the numbers, just the dates. That is the thing about evidence assembled correctly. It does not argue. It does not perform. It does not need to raise its voice. It simply sits there, and the person looking at it understands that the time for alternative explanations has passed. Stuart said, "My client would like to discuss a revised settlement framework." Claudia said, "We're open to that discussion." What followed was 4 hours of negotiation. I will not take you through every offer and counteroffer, because the financial specifics of a divorce settlement are dry, and the back and forth is exhausting to recount. What I will tell you is the shape of it, Kevin's initial revised offer conceded the hidden savings account and the investment account, but argued that the business undervaluation was a matter of methodology, not concealment, for me, and that the cash withdrawals were personal spending that had not been preserved as an asset. Claudia said, "A business generating $287,000 in annual revenue has a fair market value between $400,000 and $600,000. Your client disclosed it at $31. Bruise end. That is not a methodology difference. That is a fraudulent disclosure." Stewart said, "We're prepared to stipulate a business value of $175,000. Claudia said, "The appraiser's report is $410,000. We'll accept $380,000. Settled on $320. Froze on for the business value." On the IRA, Kevin conceded the $47,000 distribution. He argued the net proceeds after penalties and taxes, $36,000, should be the marital figure, not the gross. Harold sided with Claudia on the gross amount. Kevin conceded on the cash. Harold noted that the pattern of withdrawals, 11 transactions over 3 years, totaling $41,000, with no corresponding identified expense, free, was sufficient to create a presumption of dissipation of marital assets, which under Georgia law allows a court to credit the full amount to the dissipating spouse's column. Kevin settled the cash issue by accepting a reduction in his share of the house equity. Kevin did not look at me during most of the negotiation. He looked at Stewart or at Harold or at the table. Once, near the end of the afternoon, he looked directly at me, just for a moment, while Harold was reviewing a revised figure, and his expression was not anger or contempt. It was something quieter, something that might have been, in a different context, respect. I looked back at him. I did not say anything. There was nothing to say that the binder had not already said more precisely. By 4 in the afternoon we had a framework the final settlement provided me with. My half of the house equity, $119. $500. My half of the joint investment account, $24,000. My individual retirement account, $89,000. A cash settlement from Kevin representing my share of the hidden accounts, the business equity, and the cash dissipation, $178,000. Payable over 18 months, total received, approximately $410,000. Kevin's disclosed net worth had been $74,000 at the start. The actual settlement reflected an estate significantly larger than that. True. The difference between what he had tried to give me and what the documents said I was owed was the story of 5 months at a desk in Atlanta with a spreadsheet and a growing pile of subpoenaed records. I signed the settlement agreement at 5:15 in the afternoon. Claudia handed me the pen. I signed my name in the clean, deliberate way I sign everything, the same signature I have had since I was 22. Unchanged by the years between. Kevin moved out of the house in November. I stayed. The house had been my home for 11 years, and I was not prepared to leave it for his convenience. And under the settlement terms, it was mine to keep with a buyout of his equity share completed at closing. The first night I was alone in the house, genuinely alone, not just in separate rooms. I sat in the kitchen with a cup of coffee and the final version of the spreadsheet open on my laptop. I had been updating it as each subpoena was returned, each account confirmed, each number verified. The final version had 41 rows and 7 columns. Every dollar tracked, every source documented, every gap explained or flagged. I looked at it for a long time that night, not because I needed to read it again. I had read it hundreds of times, but because it was the most honest record of the last 16 years that I had. More honest than the wedding photographs, more honest than the joint tax returns, more honest than any conversation we had in the final years about where we were and where we were going. The spreadsheet said, "Here is what he kept from you. Here is when it started. Here is how much." I closed the laptop. I sat in the kitchen in the quiet, and I let myself feel what there was to feel. Not the anger which had come and gone months earlier in the middle of the investigation, but the simpler grief of something being over. 16 years. A house we had renovated room by room, Sunday cooking and Tuesday evenings and the ordinary texture of a shared life. None of that was erased by what he had done. It was complicated by it. Made smaller by it, maybe. But it had existed. It had been real while it was real. I was not triumphant. I want to be honest about that. People assume you feel victorious at the end of something like this, and there is a satisfaction in having been right, in having done the work correctly, in having recovered what was owed. But triumph requires an adversary you wanted to defeat, and I had not wanted to defeat Kevin. I had wanted, for most of our marriage, a partnership. The partnership had not held. What I felt, sitting in my kitchen that November night, was something more like completion, the long, low exhale of a thing being finished, the quiet that comes after a case closes. I had followed the money. I had found every dollar. And now I was done following. I returned to work the week after the settlement was signed. I had 3 cases waiting, an insurance fraud matter that had been on hold, a new estate dispute, and a referral from Claudia for a woman in Marietta whose ex-husband was a contractor who had been paid in cash for most of his jobs for 7 years and claimed his income was $48,000 a year. I opened the new file. I looked at the first page. I picked up my pen. Vroom. There is something about starting a new case that resets me every time. Whatever I was carrying from the previous one, the fatigue, the emotional weight, the particular texture of each client's pain, it does not disappear exactly, but it makes room. The new file is a new set of numbers, a new set of questions, a new trail to follow. I have been following trails for 17 years. I have found money that people swore did not exist. Fort me. I have found accounts that were opened in the names of family members. I have found business revenue, hidden in vendor accounts, and contractor payments made to shell companies and retirement funds that were supposed to be depleted, and were not. I have never, in 17 years, found a trail that simply stopped. Every trail continues somewhere, every dollar lands somewhere. The question is always whether the person looking for it has the patience and the precision to follow it far enough. My husband had 17 years of watching me work, and he still underestimated what I would do when it was my own money. That is the thing about being the capable one, the quiet one, the one who manages rather than performs. Form. People see the management and miss the capability underneath it. They assume that because you do not raise your voice, you do not know what you know. They assume that because you have absorbed the small indignities quietly, you will absorb the large ones the same way. They do not account for the spreadsheet. They never account for the spreadsheet. The house sold 2 years later. I had decided, after the divorce was final, that I wanted to start over somewhere smaller. An apartment in a neighborhood I chose for myself, not for commute times and school districts, and the logic of a life built for 2. I bought a 2-bedroom condo in a building with a gym and a rooftop terrace, and neighbors I have gotten to know slowly, at my own pace. I put the settlement money into a diversified investment account that I manage with the same attention I bring to everything financial. I am not wealthy. I am comfortable. Britming. I am the particular kind of stable that comes from knowing exactly where every dollar is and having made peace with the amount. Kevin remarried 18 months after our divorce was final. I know this because Atlanta is not as large as it pretends to be and people talk. I have no feelings about it that I have not already processed. What I have still is the spreadsheet, saved in a folder on my desktop backed up to the cloud, 41 rows and 7 columns, every cell accurate. I keep it not because I expect to need it again, but because it is the most precise record of what happened in my marriage and what it was actually worth. Some people keep photographs. Some keep letters. I keep the spreadsheet. It is the truest document I have. If you believe numbers remember what people try to hide, subscribe before the next file opens. He handed me a disclosure showing $74,000 and thought I would sign. Forgot. I had been looking for hidden money my entire career. He just never expected it to be his.